Alright, this is Ubaid on behalf of V Electronics, and in this video we're going to be talking about a pro-cyclical and counter-cyclical policy. So this is pro-cyclical and counter-cyclical policy. In a pro-cyclical policy, what's happening is the interest rates, will move with the flow of water, which means before the 1980s, the central banks, what they did during an inflationary economy, they reduced the interest rates. So this is during an inflation for pro-cyclical. They reduced the interest rates and they increased the money supply. Now, this is flowing with the flow of water, which basically means that if the economy is moving towards an inflation, it will move further towards that inflation, possibly even causing some kind of a depression, such as the Great Depression, where the inflation is so high and the money is devalued to such an extent that a loaf of bread, for example, could be bought a wagon full of money, a cart full of money. So that would be an example of a pro-cyclical approach when it comes to inflation. Now, if you were to take the other example, if you were to use a counter-cyclical policy, in a counter-cyclical policy during an inflation, the central banks will basically go ahead and increase the interest rates. And this is what they did after 1980s. And they will also reduce money supply. And the idea behind this is to reduce consumer spending, to reduce consumer borrowing, to reduce devaluation of currency, to reduce money supply in general, as a result of which, the economy recovers from inflation. There's more production than printing of money. Now, this is counter-cyclical. Now, when it comes to a recession, the pro-cyclical policy tends to move with the flow of water, which means during a recession, the government, or the central bank rather, will go ahead and increase the interest rates. And they will reduce the money supply. Now, from what we know, in a recession, the GDP shrinks, which means the money supply is reduced. Now, if you reduce it further, and if you bump the interest rates up, it will restrict consumer spending and borrowing. It will restrict net exports. It may restrict, business expenditures. As a result of which, an economy that is moving towards a recessionary economy will move further down towards a hyper-recessionary economy. Which means if you had a recession, let's say sometime in the next few years, this will make the situation worse. It will lead to the Great Recession as we know it, back in history. So that has to do with your pro-cyclical approach for a recession. The counter-cyclical approach is to reduce the interest rates and increase the money supply. So that way you've got more money for consumers to spend and borrow, for businesses to spend and borrow. Consumers and businesses, they spend more than they invest and save, as a result of which the money circulates within the economy. There's more money being circulated. The GDP grows, as a result of which the economy booms. So the economy grows. So this is your counter-cyclical policy, going against the flow of water, going against recession, and that way the central bank is able to lower down the interest rates and increase the money supply. Okay, so that would be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a great day.